quarter. As for the broader outlook for the year, let's get some insight and analysis from one of our regular market guests, Ms. Schneider, who is Director of Trading Education and Research at Market Gauge. Mish, Happy New Year. Nice to see you.
Nice to see you, John. Happy New Year to you.
Happy New Year. And obviously we've got a new year, but the same old debate seems to be raging on Wall Street. Now, let's just start with the early action this year. You could characterize it as cautious optimism. What's your take on what's been happening in the markets?
Well, cautious optimism is definitely in vogue right now, as we've seen, led by the bond markets, interestingly enough, particularly when we're looking at the high yield, high debt bond markets. They actually bottomed out before the rest of the market did last year and late last year. And so there's a couple of things to be looking at here, is that for the near-term picture, we can see equities and commodities go up together, but can that be sustainable? Because I still see so much inflation just in different places than the classic places that we saw over the last couple of years. So yeah, I think that we have to obviously look at the CPI number tomorrow will be a factor, but we have to look beyond that. We have a global inflation situation, which in some cases makes inflation even worse than what we saw in the latter part of the 1970s.
And so against that backdrop, you have the short term and what feels like perhaps a very long term storyline, which will not resolve overnight. Does that lead to perhaps an up and down style year, a choppy 2023 of trading?
Yes, well, I had written a whole outlook about 2023, and part of that is a trading range because there's been such extreme calls one way or another. But if you really just look at where things are at, let's say the Fed doesn't necessarily go much higher in terms of the yields and the bond markets flatten out. That could be good for some equities, but that doesn't necessarily mean that we're going to see any sustained growth. In fact, right now they're looking at lower growth in terms of the GDP, but yet it could still be very, very bullish for commodities. And that means that it doesn't necessarily have to see a crash, but it could mean that you really need to keep your eye on what's really trending if you want to make some money this year. And we're very much into still a lot of the commodities, particularly the metals, the industrial metals, but also the precious metals, which is something we talked about last year. So it's really set the stage, and now we can build on those positions.
That has been an interesting trend to watch this year, a growing interest in gold. We talked to a mining industry legend, Pierre Lassonde, who it's in part talking up his book, but he is making a case for a stronger demand for gold. And I think one of the challenges last year, actually, we talked to a guest earlier this hour about the fact that the U.S. dollar had been so strong in 2022. In terms of your own outlook for gold, is currency a factor in that?
Yes. If you look historically, the relationship between the U.S. dollar and the gold is not anything that you can just define as if this, then that. But given the fact that the dollar is declining and looks like very vulnerable here, any kind of short covering rally that has happened from the highs in the dollar has not really lasted too long. Under 103, DXY looks even more vulnerable. This is just another factor. What is gold really telling you here? Exactly what we're talking about, that the central banks don't necessarily have control of monetary policy, that inflation, even though we have higher yields, will affect certain areas in reducing it. We still can't control what's happening geopolitically around the world. We can't control Mother Nature. So people are flocking to a hard asset that's been undervalued, yet outperforming throughout 2022. And now we can see that as we're approaching 1900, we get through there, we could see a real parabolic move because people won't know where else to put their money. And just in terms of the Dow at 34,000 versus the gold, if you look back at 1980, when the gold was trading at around, let's call it 1,000 just to round off, and the Dow was trading at 1,000 just to round off, that's 34 times higher in the Dow and really just maybe a double in the gold. So if you just look at it that way, based on the rate of inflation, gold is cheap.
And the part that I'm really interested in as we kind of navigate through this year is at what point do we see a new conversation around long-term inflation expectations? Because if those do really change and people get used to the idea or they believe that central banks are just going to have an awfully hard time fighting inflation. Maybe that plays into the gold story. Another long-term question I have is technology. Now, we had basically a decade-long, very prosperous run for that group. And those technology stocks became the easy target when investors got jittery about higher interest rates. And now you have this fresh narrative out there that the next bull run will be different and that technology, often the case, I'm just generalizing here, but a lot of people say technology cannot lead in that storyline. I'm always curious, though, about which companies are going to show the kind of growth that will justify long-term commitments from investors if they're put up against technology stocks, despite the fact that tech stocks still have some lofty valuations. Where do you weigh in on tech right now?
Well, I'm certainly not a big fan of buying the classics, the giants like Microsoft and Apple and Amazon and Google. But there are a couple of companies that are interesting to me. One that I had actually put into my outlook was T-Tech, which is up about 6% already this morning because they just had a partnership in cloud computing with Google. And I think that the future, the thing that will pull us out of the doldrums in terms of growth will be digital technology like Meta, for example. But it's premature to me right now. They're going to still be impacted by not only the fact that they're not really necessarily mainstream at this point, that type of digital technology heading there. But at this point, again, I would say maybe 2024, 2025. If you think we get another dip down and you want to be a buyer and put it away, great. But that's not, I think this year, I really want to just keep it simple. And for me, the simple thing is to anticipate a rough year in terms of economic growth in equities with pockets of rallies hitting resistance, and keep your eye on sugar. We've talked about sugar.
We
telling
did.
you. Yes, and sugar is still pretty good right now, telling me food inflation's not over necessarily, social unrest is not over, precious metals. And yeah, if the China reawakening really turns out to be substantial, that's where your industrial metals and your food will come in. Okay. So that's really, I'm staying very focused there and not getting distracted by FOMO with any of the stocks really, except for very few.